This is your last margin call with your hosts, Beck and Tim.
Heading into week 4 of our ER series that we have here for you, it's going to be February 3rd for everyone that's out there. The Super Bowl just finished up. The Chiefs have won, beat the 49ers. Just for a time reference on, when we're filming this, we wanted to see how things were going with this open on futures that were going to happen, with China saying no one's allowed to sell, to see how the market recovers from doing this. We're currently up 21 points on ES futures, which kind of could throw a little bit of a wrench into the whole game plan that we have, but I'm hoping that things come down a little bit so that things open up right where they kind of left off from. The main thing from last week is trying to deal with the coronavirus that hit, and then trying to adjust the plays according to how much they drop down from there. So if you hear any plays that you like, make sure that you're adjusting accordingly to them, and just kind of move the strikes up or down depending on what the market is doing, but still keeping the same type of play in mind when it comes to this. So this week we're going to always break this down into 2 videos because there's just too much to do, and honestly I don't want to talk about a play that could be put on Wednesday evening or Thursday or Friday, and we have a whole week that could change, and just if everything's going up by $1 a day, maybe my play's already at max. So we're trying to adjust it as we do, break these down into 2 videos. Something new that you're going to notice, I'm always going to be putting up the IV percentile on ways that you should be trying to look into or get ideas for plays. I noticed a lot of people love that from last videos. They kind of messaged me and said that's great, I'd love to see what that is. So for each play I'm going to be tossing that up. Tonight we're going to be doing 1, 2, 3, 4, 5, 6 plays. We're going to be doing Google, which is reporting Monday after the close, Disney, which is going to be before, or excuse me, Disney's going to be before or after, and then we have Snap, which is also after, Ford, which is also after, and then we're going to be tackling GILD and Merck for the 2 bios that we have. The one thing I do want to note or tell you is that Spot and GM and a couple other plays, depending on if I want to play them or if I just see something different, I'll be updating that through Twitter. Twitter will be through Messiah Theories, and then you'll see whatever I post for fills on there, or just plays ideas in general. So if I don't get around to posting about other ones, make sure you follow there in case I do change things up a little bit. So let's jump into this. We're going to make this as quick as possible. So we have Google right now. Implied move is going to be, I put this at $100 just because based off of how Amazon moved, I'm going to try to give this as much room as possible. IV percentile is just absolutely through the roof when it comes to this, and so again, when you're looking at these IV percentiles in the 70th to 100th range, you're selling straddle strangles, iron butterflies, you're looking at credit spreads, iron condors, and broken wing butterflies if you want to get fancy, but you're not going to want to be a buyer of premium because it's just going to get shat on left and right, whether it be a crush or whether it just be you pick the wrong direction. Most likely you're just going to end up getting killed on those plays. So that's why you want to tackle this. So you're looking at a range currently of 1430 is where it's at right now, so up to possibly 1550 or down to possibly 1300. So playing within this, what we came up with, we got 2 plays for you. It's going to be the Iron Condor, and you'll see everything that's going to be up on the screen. Follow the lines on what the profit will look like in terms of what your max risk and reward will be here. Is going to be a 1295, 1300 for the put side on the Iron Condor, and it's going to be a 1535 to 1540 for the call side on that. The max on this should be, depending on where you get filled and depending on where we open, that's how this can fluctuate a little bit as well. You're looking at $175 if it stays between those two ranges, and you have a max loss of about I think it's about 330 if I remember right. I have this all written down, so I apologize if anything changes or you don't get filled accordingly, that things are different from you, but the same risk ratio should be on par with that as well. The other plays, since I'm going to be waiting for this to open up and not coming in there pre-biased and anything else like that, what I really would love to do would be looking into credit call verts. And if you don't know what credit call vert is, you're going to be selling a call and then grabbing a further out the money call on that. I just don't know what I want yet, and I want to see how this opens before I fully commit to something and saying, right now ES futures are up 21. You know, what happens is this opens up above close to 1500 for some odd reason. Like, I want to get closer to as possible to the actual report date when it comes to selling any credit call verts when it comes to that as well. So those are the two plays that we have, and again, you'll be seeing them posted. I went through them really quick, I understand that, but I want to make this a snappy video. Next one is going to be Disney. It's expected move of $8 when it comes to this. So $8 off of 38, you're looking at a 146 max up. I kind of just put it right at the 50-day for my implied move, because if it pops over that, it probably is going to do insanely well anyway and continue above that, or that's probably where investors are going to be looking to kind of maintain, hold it, and get in for their clients, or keep it under that for anybody who's short that stock as well. This was the Disney Plus release. This is going to be they're Frozen. Avengers was already on that. There's a couple other movies that are out there going into the winter season of their parks. ESPN and their Hulu packages could be doing insanely well because of the Disney Plus packages that are added on to there. Again, it's going to be looking at, I think everyone's going to have all eyes on subscriber numbers when it comes to that. So that's what you want to have your bias going into if you think Disney's going to miss on subscribers numbers, which I don't think you should. But in terms of what they actually want from their growth, what they were expecting, that's what you should be looking at. Again, IV is through the roof on this, so you know you're going to be selling straddle strangles, iron butterflies, credit spreads, iron condors, butterflies when it comes to this as well. We have 3 plays for this. The reason why I did 3 plays is because it's so popular and people need different biases when it comes to this. So the first one is going to be a 133 131 credit put vert. That means you want it to go up. It means it allows it to drop, but allows it mainly to look to go up, selling the 133, buying the 131 for protection. You're getting a max of $52 out of this per contract with a max downside of 148. Obviously, the ratio is going to be to the downside when it comes to this because you're selling. All right, so you're never going to get that, or otherwise it's a debit vert. You're paying for it anyway. So you're hoping for, you know, either to stall out, drop a little bit, or pop, and you'll collect all that $52. Great, move on, next play. All depends on how much you want to put up when it comes to that. The other one is a broken wing butterfly, and it's going to be the 140 142 143 calls when it comes to this. So let me just pull that up real quick, sorry. It is going to be, you're going to be looking at it to move up from where it's at. All right, and if it stalls right after the 143 mark and it comes down to the 140 range again, that's when you hit your biggest spike. And when it comes to this market conditions right now, where the fear of this virus is well known and out there, so anything they do well on, you maybe could see it pull right back from that and just, you know, where did it go? It was amazing numbers, it doesn't matter, so it pulls back to that range. But if it just absolutely beats out of the water, you're still making $55 no matter if it goes up from 143 up. The downside is $45 if it drops anywhere below 140. So it's a very bullish play, but you're protected, or you're trying to get a profit spike somewhere outside of this, but you just don't care how far out, and you want it to be cheap as possible. And by cheap, I mean $45 to put this on, and a max. And since it's debit, that's the max you could possibly lose on this. But you want a pop stall, and you want it and continue forward. So I think it's good for that, especially if you contain a bullish perspective on this instead of just doing verts when it comes to this. Because if there's an IV crush on this, if you're just, you know, who knows, maybe it just stalls out right where it's at, or if it drops down a little bit, you know, verts can still cost you a little bit, about the same. Like, I think we would probably run about like the 60s to 70s for anything to get like a good actual play out of that. So it's on the cheaper side when it comes to this. The other one that I have is going to be a fancy play. Typically double diagonals are spread out over the course of a couple months, but again, I'm trying to hit every play, use as little capital as possible. So when you're looking at a double diagonal, it's going to be $16 to put this on. All right. For what you're going to do is you're basically making the Batman helmet when it comes to this, and you're hitting spikes on the ranges where the expected move is supposed to happen. So if it hits that expected move to the downside, hits the expected move to the top side, that's when you're making your most money. But if it doesn't, then it comes back and stays within that move. You're still making some money, but just not as much. And obviously this is going to contract a little bit as well. So you won't get that, and so will the ranges as well. So make sure that is understood. But in order to put on this play, you got to sell the 148 calls and buy the 149 calls. All right, and that's selling is always going to be this week, and then buying is going to be the next. And then you're going to be selling the 131 put and then buying the 130 put on that for a total of $16. And the max downside on this should be 116 as well. All right. The problem with putting these on is you have to let them play out. And this is a Friday play. This is into next week. Once you collect the money from each side that has hit zero, whether it be you put or call, get out of it, head, and start working and navigating the other side of it. It is I would say it's a managing trade. It's something that you probably don't want it to let it play out, especially under these short-term conditions. Under a longer-term condition where you got like the 60 DT, when it comes to this, you kind of want to let it play out a bit. But here I'd say active management is going to be your best option when it comes to that. So it's $16 to put on, obviously, debit, 116 to the downside. When you get to the profit spikes on here, 148 is going to be your 285 you could possibly make, and then a 131, 215. All right, and then in the middle, anywhere in between there, 75. So anywhere between those ranges, and obviously that's going to contract a little bit, just due to the IV changes when it comes to this. So expect a little bit more or a little bit less than that, but also playing within that as well. Okay. Another one, very popular one, is going to be Snap. So the macro side of things to consider is TikTok. How much did TikTok pull away from Snap? Obviously, I think the answer should be a lot, since TikTok's growth has been kind of crazy. So obviously users are probably not using Snap as much or anything else when it comes to this. So maintaining a mildly bullish perspective, if you're saying, oh, whatever, screw TikTok or whatever, but still looking a little bit to the downside with a stall or bearish tone to that. And when it comes to that, I think there's only one play that kind of fits when it comes to this. And obviously I'm a fan of broken wing butterflies when it comes to this, because it allows you to play 2 out of the 3 perspectives. And then also you can kind of get in a little bit cheap when it comes to this. So the broken wing butterfly is going to be a 19 call, buying it, selling 2 of the 19.5 calls, and then buying a 21 for the protection to the upside as well. It's a 19 credit when it comes to this. So that's your bullish perspective, that if it pops, just because the chart is a little bit technically into a falling or bull flag when it comes to this. So if it pops up off that, you don't care. And I think it's at 120, or no, excuse me, not 120, $20, which plays right into that 52-week high where you still make money, but you're making your money off of the secured downside that you have with the $19 off of that. And that's something you could take multiple contracts off of. The only problem is if it hits 21, you're losing $81 per, which is a lot. But again, I have a bearish sentiment when it goes to Snap because of TikTok's pull, with Facebook's reemergence, with their importance of all the different things that they have. So I think taking a bearish sentiment while allowing a minor pop on that is going to be your best option. And then we're going to go into Ford. Ford is the next one. And again, I apologize for how fast I'm doing this. I want this to be really easy and a quick listen. Ford, the implied move is going to be about, no, we'll put it at 60 cents to be even. Trading at 880 right now, so 990, or excuse me, 920, and then 840 to the downside. It's just one of those plays where Ford doesn't move at all. So collecting premium you're not going to get anything. Like, I think when even playing the implied move on an iron condor, you're getting about $25, and you have to maintain that the whole week. You have to hold on to it with 75 to the downside, which is typical. So it's just whatever. So you know what, I said this is going to be the one time we're going to let low environments, and you're in that IV percentile that we're talking about again, where you're buying debit spreads, calendar spreads, ratio spreads, diagonals. I don't want to hold on to a calendar. I don't want to hold on to a diagonal and manage those ratios, whatever. I'm not going to do that. So just flat out just grabbing calls here on the February 21st $9 calls for about 22 cents. I think they're running. It's a bullish perspective on that as well. So if you're bearish, maybe just take the opposite thing, grab like an 850 to the downside. But I'm doing the February 21st 9 calls, and it's super cheap, so why not? And Ford sucks anyway, and it's a terrible thing, but a lot of people play it for some reason, so we can roll off that. And then the next one is GILD, GILD. This is one of the companies that kind of spiked off of the saying, hey, we're working on a vaccine for the coronavirus. And I think that's why it spiked a bit after hours as well. I'm not 100% certain when it comes to this. But the implied move, you know what? I'm gonna toss out the implied move when it comes to this. There's a play that I kind of really want to run when it comes to this, just based on the monthly chart that we have in here, and I'm going to actually use the monthly when it comes to this as well. I personally think that it's at like one of those like pivotal levels where if it breaks to the downside, all right, great, let's find a way to cap that downside. But if it breaks to the upside, finally, like it's kind of been trying to do for, what is this, years? Yeah, years now. Let's find a way to make this beneficial and not be capped to the upside. So you have a 70-72.5 back ratio for March, or for May, sorry. So it's a long dated play, 3-4 months out when it comes to this. It takes $20 to put on. The max downside is 270. But if this thing gets moving like it should based off of the chart pattern itself, you know, this could really get going over the next couple months and to the upside. So, and you want to have that unlimited profit range. So I think a back ratio would be perfect here. And if all of a sudden, you know, it finally breaks under that $60 support that it's been holding for, you know, was it a couple of years now? You know, you're capped at least, you know, you're not fearing. So the only major drawdown is going to be if it breaks out, stalls after it breaks out, and then hits there. So I think that's fine. And it's a longer dated ER play because I think it's fitting based on the chart. And then that leads us into Merck when it comes to this, MRK, sitting close to all-time highs in a sense. But another thing where healthcare, I think, is, I said it previous that, you know, I think healthcare is going to be huge, especially the more concern that the coronavirus has, that the overall sector is going to get a lot of attention, whether it be to the downside or upside. It's going to be a main focus. So when I thought about that, it's had these great bounces, just great bounces over the course of the whole year, 52 weeks at this 200-day. And it's almost right at that 200-day again, where it makes large pops. All right. So large pops, limited downside. And what would be a great play for this? Another back ratio when it comes to this at a 87.50/90 back ratio for $57. It's almost the same downside, about 270, 80-ish. I'll have it up there so you can just look at it there and kind of go across on that. But it's another thing where if it has a hard bounce off that, you know, you're going to get that move kind of almost like you have the underlying itself, but it's going to exponentially grow the further it gets past that, because you're shorting one and longing two out there, and that's how you make that back ratio. You're going to get the upside on that. And if this finally goes and healthcare goes with this, you know, you're in a great position for multiple months. Like with the May thing, you're taking Mays on these as well, where you could catch some really good momentum. And healthcare's took a nice dip along with everything. What a great pullback and a time to refocus and dive back into this. All right. So those are our plays, our 6 plays. Google, Disney, Snap, Ford, GILD, Merck. I know I didn't do GM, and I know I didn't do Spot, and those are things. So again, I'll say it. If you want those, I'll probably try to find something during the week, and I'll try to get those up before Tuesday, because those are Monday opens. So you have to get in before Tuesday. And I'll try to get that big Messiah theories on Twitter, and you can just follow my posts and see if I say something about it if you're that interested. And then next video, we'll dive into QCOM, Peloton, obviously. It's always, everyone will have fun with that. FireEye, Twitter, Bristol Myers, Uber, Activision, T-Mobile, and ABV. Those are going to be the plays for the week, so that one's going to be a little extended. It won't be as quick, but I'll try to talk as quick. So we'll see how this goes, and I'm kind of excited, but I'm also seeing that hopefully there'll be a little less turmoil in the market and a little more flow in a certain direction, but not hit us overnight and screw up the whole entire last video and have the readjustment that we did. So we'll see you Tuesday afternoon, most likely, when I'll post the next video. Have a good night.